All right, so welcome back to phase 2, lesson 2, risk management. So this is something that's very, very important and something that every single trader needs to keep in mind and implement at all times. And this ties in with psychology, because when you're over leveraging your account and you're not following your risk management procedures, that loops back into your psychology and what you're thinking. So these two go hand in hand. And this is something that's very important, and there are no profitable traders that do not use risk management. One of the biggest lessons I have ever learned is that no position in the market is still a position in the market. Sitting back and watching and letting the price do its thing, and if you don't see any setups, not taking them, is one of the truest forms of mastery, like I've mentioned in the previous video. So we're going to get a little bit into risk management, the compound calculator, what proper risk to reward looks like, and how to calculate your lot sizes properly so you don't end up blowing the entire account. Because ultimately we want to create a consistent equity curve, not a giant leap up as fast as possible, because that is a race that you will never win if you are in a rush. All right, so here we have a compound calculator. So at the top, you can see the initial deposits are $5,000 with 0 weekly deposits and a projected ROI of 5% a week. Just 5% a week, not 15, not 10, not 20% a week. A 5% a week consistent profit. And that means if you hit 5% in one day, that means not trading for the rest of the week all the way until next week. Because what will happen is if you hit your weekly goal of 5% on Tuesday, Wednesday, Thursday, Friday, you're going to want to trade and you're going to end up losing all that 5%. I can promise you that's going to happen. It's happened to me. It's happened to every single trader. If you hit 5% on Tuesday and you're so amazed, you're feeling euphoria, you're feeling good. Like we mentioned in the Wall Street cheat sheet, that feeling of euphoria, people start putting way too much money into their investments when it's already expanded rather than waiting for it to retrace. But if you trade Wednesday, Thursday, Friday because you had a good trading day Tuesday, even though you hit your weekly percentage, either do not trade, just sit back and watch the markets, or go do something else, or do some back testing, or go onto a demo account and trade. But if you hit your weekly goal, do not try to then hit some more, because what's going to happen is you will end up losing everything you've gained on that day. I can almost guarantee that's going to happen to you. So here we're looking at a consistent 5% a week equity growth. So the starting initial deposit will be $5,000. So you can see after week 1, with a 5% profit or $50, the account's now at $5,050. Going into week 2, the profit on week 2 makes the account look like $5,302, and so on and so forth. And this is exponential, so as the account grows, so will your returns, because 5% of 5,000 is not the same as 5% of 50,000. So this is a very beautiful equity curve that we would be looking to go for. So right here, you can see after 3 months or 12 weeks of trading with a 5% equity growth, that initial $5,000 deposit looks like $8,637.21. That's without depositing or withdrawing, just simply hitting a 5% weekly equity curve, which is absolutely doable. This is on the low side. This is not on the high side by any means, especially when you're margin trading Forex. If you're looking at a diversified portfolio in stocks, bonds, commodities, and index futures, then typically you're looking at 3 to 7% a year. Okay, so those are very slow growing processes. This can scale up quickly if done properly. So after 12 weeks, your account would look like $8,637. Now, after 6 months or 24 weeks, that initial $5,000 deposit on just a mere 5% a week is now sitting at $15,511.19. Okay, so take that into perspective, that by simply pushing a button on your phone, using proper risk management, having good trading psychology, and going for a very low bar of profit, which is 5% a week, you're looking at $15,000 after just 6 months in the account. Okay, so you can see that's 3 months there, 6 months. If we look at 12 months, 1 year later, that initial $5,000 has become $60,805.89. Okay, this is more than what a lot of people work for year after year after year. And this is without working a job. This is just pressing a button on your phone. Now, this is not including withdrawals. This is not including deposits. So keep that in mind. This is just for perspective here. But if you maintain that 5% a week, you'll be looking at $60,805.89 in the account. All right, so how much of your account do you actually risk? And there's a lot of people that say different things. However, I've been in this space long enough and I've talked to enough traders, and I personally traded accounts with lots of risk, very minimal risk, moderate risk, and so forth. And through my experience, through my trials and tribulations, through all of my connecting and chatting with traders and everything that I've heard in the space, the ideal risk that you want to be risking is 1 to 3% of your total equity per trade. So let's say you have a $5,000 account and you're risking 1 to 3%. That would be anywhere from $50 for 1% to $150 for 3%. Do not start trading 5% risk because you want to make money quicker, because that is a great way to lose money quicker. We are not here to gamble. We're not here to over leverage our accounts. 5% is much too high if you're looking for a consistent equity curve. If you're looking for it to go straight up and just hope that, you know, it's going to go up and up and up. If you have a smaller account and you're risking 10% per trade, and let's say you hit 2 trades and now your account has tripled, and then you keep using that equity, it's going to come right back down crashing on top of you. So it's best to stick between 1 to 3%. If you're looking at a smaller account, then 3% is more likely that you're going to use. Once your account starts growing in numbers, 1% to 2% would be ideal. Now, there's something that's also a very great trading strategy, which is some people, what they'll do is they'll cut their risk in half. So if let's say they have a point of interest that they're looking at and they're not quite sure where price is going to react out of, they will do something called twin trading. So let's say their risk is 2% of their total equity. So what they'll do is they'll put 1% on an entry with a stop loss above or below the previous low, where they would deem their trade invalid if that breaks. And then they will take the other position and they will put it on the same point of interest but a different area. And this is called twin trading as well. So you don't have to put all of your risk on one trade. You don't have to do the full 2%, for example, on one trade. You can take your risk and divide that up into little trades. Now, this is also something that we're going to mention going forward as well, talking about trading plans, trading plan development, and stuff like that, about daily loss thresholds, daily gain thresholds, and such. But just to keep in mind, for an average risk parameter, you want to be risking 1 to 3% per trade. All right, so getting into risk to reward here, and this is something that's extremely powerful, and this is something that you must understand, which is the power of risk to reward. Okay, so taking the initial $5,000 deposit, and your risk is 1 to 3%, which is $50 to $150 a trade. Going for a 1 to 3. Now this should be minimal. If you see a setup that does not give you at least a 1 to 3, you should wait for a setup that does, because this power of risk to reward is something that you want to leverage. Because if you're hitting 1 to 1s all the time, you need to have a minimum accuracy of 51% to be profitable. But 51% still is not going to get you to where you want to be. So you'd need to be more like 75-80% profitable if you're hitting 1 to 1 risk to rewards. If you're going for a 1 to 3 minimum, I would say this would be minimum. Ideally, 1 to 5s are nice as well. Personally, I've hit a 1 to 364 before. Now, I don't do that all the time, but I've done it. I've hit 1 to 20s, 1 to 25s consistently. So 1 to 3 should be your bare minimum. And you'll start recognizing you're able, as you become a better trader, you're able to understand the smaller time frames and minimize your risk so your reward gets maximized. But overall, minimum 1 to 3. So if you're going for a 1 to 3 risk to reward, 33% accuracy is going to get you break even. So if you lose one trade and then you lose one trade and then one trade hits the take profit, that take profit, if you lose 1% on the first trade, you lose 1% on the second trade, and then that next take profit hits 3%, then if you got -1, that's -1, and then +3, that's +1%. So you need a minimum 33% accuracy to be profitable. Ideally, you want to be more accurate. The goal is to be at 100% accurate, although nobody can ever be 100% accurate. You're going to take losses. That's just part of the journey. But you want to really understand the risk to reward, because over a series of 10 trades is what you want to base your criteria on. You're not going on a trade by trade basis. You're not looking, okay, I lost this trade yesterday and I lost a trade the day before, and then today there's a setup, but I'm scared to take it because I just lost 2 trades. But you risked 1% per trade. So let's say you've lost 2% because you lost 1 yesterday and the day before, and you're looking at a setup that matches your confirmations, and it's a 1 to 4, for example, and you don't take it, and then that is the trade that's always going to be the winner, the one you don't take. So you need to have your edge defined and take every trade that matches your analysis, because right there you would have made a positive net 2% ROI if you took that trade. And the goal here is to create a consistent equity curve. So it's not a race, it's not a competition. It doesn't matter how big someone else's account is, it doesn't matter how many times they're trading, if they have 14 different entries. Okay, you just need to focus on your style and your trading and create your own equity curve. Do not be focused on all of these other people that are trying to be flashy and show you they hit a massive risk to reward, and you know they're getting 6 different entries. Because I can almost guarantee you, anybody that shows you a screenshot of their phone or their charts and they have 5, 6, 7 different entries in the same area, that is almost guaranteed to be not truly a profitable trader. Because a profitable trader will not spam the buy button in the same place. They'll either twin trade, or they will take one trade and then they will have entries on pullbacks. But if you see a bunch of different entries all around the very close area, it's likely that price came into their area, started reacting, and then they just started throwing on more lots to catch the move and over leveraging their account. So it's not a race to make as much money as possible, as fast as possible. The whole goal is to grow your equity curve and the balance in your account. Alright, so getting into lot sizes here, this is something you're going to want to write down, have it handy. This is something I have memorized now. It doesn't take that long to memorize. It might seem a little complicated, but trust me, this is very simple. Once you see it, you're going to be able to calculate lot sizes on the fly with no ease. I also mentioned the Stanu app for calculating lot sizes. That app is great. I still use it from time to time. However, for the most part, I've figured out how to calculate these in my head when I'm trading. but I'll still use this new app from time to time if I'm cutting my risk in half and then both my stop losses are different sizes. So this is something that's very, very valuable. But taking a look at the right here, we have a trade that was a winner, and the risk was 10 pips, and the reward was 50 pips. So that's your 1 to 5 risk to reward. Now, you can see the lot sizes. For a 0.01 lot size, which is the minimum you can do on Forex, that is going to be 10 cents per pip. On a 0.1, that is $1 per pip. On a 1.0, that's $10 a pip. And on a 10.0 lot, that is $100 a pip. There's a little error in the slide there, but 10.0 is $100 a pip. Okay. So if a 0.1 lot size is used, how much is the risk? So you can see the risk is 10 pips, and we have a 0.1 lot size. So you're going to see how many dollars is that worth. So do some math on that. And I'm going to have 3 questions here, and then I'm going to have you pause the video, do the math, and then come back to the video and see if your answers were correct. But question number 2 is, if a 1.0 lot size is used, how much is the reward? So you can see 50 pips is the reward, and you're using a 1.0 lot size. So how much money would you make if you use a 1 lot on a 50 pip profit? And the final question would be, if a 0.15 lot size is used, how much is the risk? Now the 0.15 is not on the left, so that is a little bit of extra math you're going to have to do. But if the risk is 10 pips and you use a 0.1 lot size, how much money is that? All right, so you can go ahead and pause the video here, do some math on these, and then when you're ready, you can unpause and we'll go over the answers. All right, so trusting that you paused the video and you haven't just waited for 3 seconds and then come back. Really make sure you do these on your own time, because it's going to be very beneficial, and it's okay to be wrong, but it's even better to learn from your mistakes and notice where you went wrong. All right, so the first one, if a 0.1 lot size is used, how much is the risk? So if a 0.1 lot size is used, the risk is $10. So a 0.1, if we look at the left side there, 0.1 is $1 a pip, and the risk is 10 pips. So if you have a 0.1, which is $1 a pip, and we have 10 pips, that would be 10 times $1, which is $10. Right. Answer number 2. If a 1 lot is used, the reward is $500. So looking at the left again, a 1 lot is $10 a pip, and we can see the reward is 50 pips. So we have $10 a pip and there's 50 pips. We just simply multiply the $10 by the 50 pips, and that gets you $500 would be your reward if you used a 1 lot. All right, final answer. If a 0.15 lot is used, the risk is $15. So if you look, 0.1 lot size is $1 a pip. So a 0.15 lot size is $1.5 a pip. So we take $1.5 and then we have 10 pips. $1.5 times 10 would be $15. So that's how you would calculate it. So this has been calculating pips and lot sizes, risk to rewards, compound calculator, and risk management. So study this, take some notes. You can write your own questions out if you would like, and I will see you in the next video.